Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
$14.55. That is exactly where EOS Energy Enterprises, ticker EOSE, closed the session on January 30, 2026. Now, if you're just glancing at the daily chart, you see a stock taking a bit of a hit, right? Down 9.68% on the day. Volume was moderating, but still significant. But you really have to zoom out to see the real picture here. We are looking at a stock that has run from a 52-week low of, $3.07 to testing the $17 range just a few weeks ago. Right now, what we're seeing is a critical support zone forming right around that $15 mark.
Okay, hold on. Let's just take a breath for a second. That consolidation you're describing, that is not normal market movement. That is the sound of a battleground. You have to remember that as recently as mid-December 2025, short interest on this name was nearly 30% of the float. That's massive. It was a complete powder keg. So when you see these surges like the 13% jump on January 2nd or the nearly 19% rip on January 14th, that isn't just fundamental buying. That is a mechanical squeeze. The market is currently pricing in absolute perfection. They are not pricing in survival anymore. They are pricing in a seamless transition to massive scale. And a 10% drop in one day, that tells me the market is incredibly nervous about whether EOS can actually, pull this off.
I think the market is just waking up to a reality that maybe you're missing. We aren't talking about a science experiment anymore. The thesis here, the whole reason we are seeing this repricing is the industrialization of zinc. EOS is at a pivotal inflection point. They're moving from an R&D firm to a high-volume manufacturer. The world has realized that lithium-ion cannot do it all. We need long-duration energy storage, LDES, and EOS has the tech. They have the $303.5 million Department of Energy loan guarantee, and they have the target market in AI data centers.
See, I get the narrative, and honestly, it's a beautiful narrative. I'll give you that. But then I look at the valuation, and I see a disconnect. We are trading at roughly 63 times price to sales. That's a software multiple for a company that bends metal and mixes chemicals.
That is such a backward-looking metric.
It's a reality-based metric. They're still burning cash, over $160 million used in operating activities in just the first 9 months of 2025 alone. And while EOS is trying to ramp up, the price of lithium iron phosphate, LFP, has crashed by 45%. It's down to $70 per kilowatt hour. Your incumbent competitor just got a whole lot cheaper. And EOS has a history of negative gross margins, negative 111% over the last 12 months. You are paying a premium valuation for a company that, mathematically, is still losing money on every single unit it ships.
But if you focus only on the trailing 12 months, you miss the turn. The negative margin is shrinking. It used to be negative 233% in Q1 of 2025. Now it's negative 111. The trajectory is the story, but let's get into the why behind these recent moves. You mentioned the volatility, but you kind of glossed over the catalyst. The Department of Energy loan guarantee closing on January 2nd wasn't just a check. It was a seal of approval.
Provides liquidity, I'll grant you that.
It provides bankability. When the DOE puts $300 million behind a technology, utility customers, they listen. This funding is specifically for Project AMES, the $500 million expansion to reach 8 gigawatt-hours of capacity by the end of 2026. That is the industrial scale I am talking about. And look at the manufacturing data. They've implemented sub-assembly automation at Turtle Creek. They have cycle times under 10 seconds per module now. That is how you get to positive gross margins.
Automation's great, but let's talk about where this demand is supposedly coming from. You brought up AI data centers. This was the big headline from the January 14th Investor Day that popped the stock 19%.
The launch of the in-density architecture.
Right, in-density. It sounds like a cologne, honestly. But the claim is they can pack energy in tighter.
It is not just a claim, it is physics. They are achieving 1 gigawatt hour per acre. That is roughly 4 times the density of standard long-duration technologies. Now, why does this matter? Because AI data centers are being built in urban environments or on tight campuses where land is expensive and scarce. They cannot just sprawl out with acres of shipping containers. EOSE allows them to stack power vertically. It is the perfect solution for the hyperscaler power crunch.
It is a great story for a PowerPoint deck. AI hype is the flavor of the month, but can they build it? You mentioned Project AMAZE. That requires integrating over 30 discrete operations per production line. I mean, if there is a single mechanical failure or a delay in commissioning lines 2 and 3 at Marshall Township, that revenue guidance misses. And if they miss revenue with this valuation, the stock gets crushed.
That is standard execution risk for any manufacturer.
But the margin for error here is zero. And I want to go back to the tech itself. You are betting the farm on this Zenith technology, zinc bromine.
Because it is superior for this specific application. It's water-based, it's non-flammable, there is no thermal runaway risk.
Which is a valid point.
It is the point. If you are Microsoft or Google, do you really want a lithium-ion bomb sitting next to your billion-dollar server farm? EOSE batteries can go to 100% depth of discharge without degrading. They last 20 years, and they don't need expensive HVAC systems to keep them cool because they love heat.
Sure, safety is a selling point, I get it. But cost is the deciding factor. With LFP batteries at $70 per kilowatt hour, EOSE has to drive their bill of materials down, and I mean aggressively. Zinc is cheap, yes, but their manufacturing process is still inefficient compared to the gigafactories churning out lithium batteries.
You are looking at the sticker price, not the life cycle cost. But even on revenue, you're missing the layers. It is not just selling the Z3 Cube or in-density hardware. They have long-term service agreements. They have the Dawn OS software, which is high-margin recurring revenue. And most importantly, do not forget the Section 45X tax credits.
The government subsidy.
It's industrial policy. They can get up to $45 per kilowatt hour in tax credits for U.S. manufactured batteries. If they hit that 2 gigawatt hour line, that is $90 million annually just in credits. That changes the margin profile overnight.
Assuming the legislation doesn't change, relying on Section 45X is a regulatory risk. But I want to talk about how the market is valuing this compared to its peers. Let's look at Fluence Energy, ticker FLNC.
A different business model.
But a relevant comparison. Fluence has a market cap of around $5.7 billion. EOSE is sitting at roughly $5.2 billion, so they are nearly the same size in market cap. But Fluence has $2.26 billion in revenue. EOSE has, well, a fraction of that? Fluence trades at 2.3 times sales. EOSE trades at 63 times. Why would I buy the unproven zinc company at a 63x multiple when I can buy the market leader at 2x?
Because Fluence is an integrator. They buy batteries from CATL or others, and they put them in a box with some software. Their margins are squeezed by the battery suppliers. EOSE is a pure-play manufacturer. They own the IP, they own the factory, they own the chemistry. That commands a premium because the leverage on the bottom line is so much higher once they finally scale.
Or the risk is higher because they have to actually build the things.
Look at STEM Inc., STEM, if you want a cautionary tale. They struggled with liquidity. EOSE solved that liquidity issue with the DOE loan and the $600 million convertible note refinance. The market is valuing EOSE on its 2027 and 2028 capacity. If they hit 8 gigawatt hours, that revenue number jumps 10x. You buy growth, not history.
You buy probability. And speaking of probability, let's talk about the people running the show. I get nervous when I see insiders selling during a supposed breakout year. In January 2026, Nathan Croker, the CFO, and Michael Silberman, the CLO, sold tens of thousands of shares.
You have to read the footnotes on that.
It is still selling.
It's Rule 10b5-1 selling. It was automated. They sold to cover tax withholding obligations for RSU vesting. That is standard corporate housekeeping. It wasn't a lack of faith.
It still shares hitting the open market.
But look at the buying history. Look at the CEO, Joe Mastrangelo. He bought shares in the open market when the stock was dead in the water, between $1.43 and $2.23. He put his own money in when absolutely no one else believed.
I will give you that.
Mastrangelo has a decent pedigree.
Decent. The man is ex-GE. He ran Gas Power Systems, 15,000 employees, 60 countries. He has GDNA. He is obsessed with lean manufacturing. That is why they are hitting that 10-second cycle time. He is not a promoter. He is an operator.
He is an operator who missed his product cost targets in 2024, which is why his bonus was cut. He is not infallible, and the institutional ownership reflects that caution. Yes, BlackRock and Vanguard are there, but they own pretty much everything.
We saw Rubric Capital take a massive new position in Q3 of 2025. That is a sharp, active fund betting on the turnaround.
Okay, let's make this real for people listening. Let's say someone puts $5,000 into EOSE right now at around $14.50. What does that look like in, say, 3 months?
Short term, it is all about the Q4 earnings on February 20th. If they confirm positive gross margins even slightly, this stock retests the Guggenheim target of $20. Your $5,000 becomes nearly $6,900. That is a 38% gain in a few weeks.
Or they report another noisy quarter. And you know how their financials look. Those mark-to-market adjustments on warrants can make the net loss look like $641 million. Retail investors see that headline number, they panic, and they dump it. Or they miss the $150 million revenue floor, the stock drops to support at 10. Your $5,000 is suddenly $3,450.
That is the volatility tax. But look at the long term, 3 to 5 years.
Okay, this is where it gets speculative.
It is where it gets exciting. If Project Amaze works, and the DOE seems to think it will, they hit their 2028 projections, $1.4 billion in revenue, $275 million in earnings. Apply a conservative 20 PE to that, and you are looking at a $45 stock. That $5,000 investment becomes over $15,500, a 210% return.
That is the blue sky scenario. What about the sodium ion scenario or the solid state scenario? Technology moves fast. If zinc bromide turns out to be the Betamax of batteries because sodium ion gets cheaper and faster, EOS is in serious trouble. If they fail to scale, or if they have to dilute shareholders again because the cash burn doesn't stop, this goes to distressed levels. $5 a share, your $5,000 turns into $1,700. You lose 65% of your capital.
But that risk is priced in. That is why it was at $3 last year. The DOE loan de-risked the bankruptcy thesis.
It de-risked the immediate bankruptcy. It did not guarantee success.
It guaranteed they have the runway to prove it. And frankly, the AI data center demand is a tide that will lift this boat. They don't need to win the whole market. They just need the slice that cares about fire safety and density. And that is a multi-billion-dollar niche.
It's a binary play. That is how I see it. It is not an investment for the rent money. It is a satellite position. If you can stomach the swings, and we're seeing 10% swings in a single day, then maybe you take a bite. But the valuation leaves zero room for error.
I disagree on binary. I think the floor has been raised. The solvency question is answered. The product safety question is answered. The only remaining question is execution. Can Joe Mastrangelo run a factory? His track record says yes. The DOE says yes. The institutional capital flowing in says yes.
And the short sellers are still watching, just waiting for a slip-up.
Which creates the squeeze potential.
Or the crash potential.
We're going to find out a lot more on February 20th. But right now, at $14.55, I see an entry point into the industrial infrastructure of the next decade. That's what makes a market.
Indeed.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.